Welcome back to the Deep Dive, where we take a massive stack of research and notes and, well, give you the ultimate shortcut to being well-informed.
hmm
Today we are heading out to the country, sort of, to explore a really unique corner of retail. We're looking at how one leader in the sector manages to combine, incredible resilience with some seriously aggressive growth ambitions.
And the company we're diving into is Tractor Supply TSCO. And our sources are looking at it not just as a stable retailer, but specifically as a top dividend stock idea for 2026.
Right.
This is, it's so much more than just a store for feed and farm supplies. We're really looking at a highly refined niche business model that's created this powerful, financially resilient engine.
Absolutely. So our mission today is to unpack the core thesis, the main arguments supporting this strong investment claim. We're going to distill 5 key pillars that underpin their resilience and their future growth.
And a lot of that focuses on how this niche retailer built such a powerful competitive edge, one that's, well, it's incredibly difficult for the bigger rivals to breach.
Okay, so before we get into the numbers, I think it's crucial to establish that context.
Yeah, you have to. TSCO is considered the clear leader in serving rural America and, importantly, the hobby farming customer.
Hobby farming.
Exactly. This isn't your typical general merchandise retailer that goes up and down with the economy.
Yeah.
It's a necessity-based business. They really own their lane, and that unique positioning is, I think, the first layer of their long-term resilience.
Okay, so let's unpack that competitive edge, because when we talk about retail, competition is, it's usually ruthless. Everything feels commoditized.
It is, yeah.
So what specific things make the Tractor Supply model so hard for rivals to copy? What is their genuine moat?
So the moat is really built from 3 distinct elements. Its physical location, the product mix, and its logistics. And this wasn't an overnight thing. It's been a decade-long effort to construct this, comprehensive nationwide footprint that specifically targets the rural customer.
The customer who isn't really served well by the traditional big box stores? Can you get a little more specific about the physical setup? Because, unique store format is a phrase you hear everywhere. What does a TSCO store offer that, say, a Home Depot or a Walmart just can't replicate easily?
Well, it really comes down to scale and specialized inventory. The stores themselves are just fundamentally different. They often sit on these large parcels of land, sometimes 5 or more acres, which lets them have these massive fenced-in outside yards.
Oh, okay.
And that space is absolutely essential for housing bulk feed, fencing materials, lumber, and heavy equipment. The very stuff that's just prohibitively expensive, or frankly, a logistical nightmare for a standard big box store to keep in stock.
That makes perfect sense. Their core inventory, animal feed, vet supplies, livestock equipment, it's all necessity-driven and it's bulky.
Right.
It needs a different kind of supply chain, and critically, it's probably low margin and specialized, which means those big rivals, they just don't have much incentive to try and compete aggressively.
Precisely. And that necessity-driven inventory, that also contributes to the business's resilience. The hobby farmer or the rural resident, they need animal feed or tractor parts whether the economy is in a recession or boom.
Right.
This structural aspect just makes their customer base inherently less volatile than, the general consumer who might be buying more discretionary stuff.
That structural advantage is key. Now, what about the customer relationship part? The sources mentioned a fast-growing and valuable loyalty program. What makes this Neighbors Club so important?
The loyalty program is really the third pillar of their moat. It drives predictability and stickiness.
Stickiness.
Yeah. The Neighbors Club is incredibly effective. It drives something like 75% of their total sales.
Oh, 75%.
It's a huge penetration rate. And it means they have fantastic insight into their customers' needs, their patterns, their preferred products. It lets them personalize marketing, and it ensures those customers just bypass the generic competitors because they're already in the TSCO ecosystem.
So that's a powerful foundation, a resilient niche, necessity products, and this super engaged customer base. That structural strength is what supports the aggressive financial profile we're about to get into.
Exactly.
So now that we've established that moat, let's look at the financial proof points, starting with the dividend story.
Okay, so let's turn to the payout itself. This makes up the first 2 elements of the bullish thesis: the quality of the yield and, maybe more importantly, its security and its growth profile.
Okay, so focusing on the yield first. The dividend sits at about 1.7%. What stands out there is how that compares to, the market average.
Right. And that yield is well above the S&P 500's average, which is currently sitting at, around 1.2%.
So it's a decent premium.
It's an attractive yield, but what really makes it solid is the track record. The company has raised its dividend for 16 consecutive years.
16.
And we're not just talking about little token increases here. Over the last 5 years, the dividend has more than doubled, and that's after adjusting for stock splits. That's a pretty clear sign of their commitment to capital return.
That consistency is impressive for sure. But for a dividend stock idea to be really compelling, you have to look at the security of that payout.
Oh, absolutely.
Which brings us to the second financial point. The significant room they have to actually keep increasing it for years to come.
Absolutely crucial. The source material notes that the dividend consumes, and I'm quoting here, a little under half of the company's earnings. Specifically, the payout ratio is 44%.
44%.
Yeah, so for you, the listener, this basically means the company has deliberately structured its payout to be conservative.
So they're not pushing their financial limits at all. What does a 44% payout ratio let them do that, a company with a higher payout can't?
It creates this massive financial buffer. It means they're retaining 56% of their earnings for internal investment, share buybacks, or future dividend growth.
So flexibility.
Total flexibility. It allows for continued payout growth even if the business hits a temporary earnings headwind, which, as we discussed, is less likely given their niche, but the safety net is there regardless.
They're balancing growth with capital return really masterfully. Okay, that's the financial stability piece. Now, let's pivot hard to the current business momentum.
Great.
Because no matter how secure a dividend is, the underlying business has to be growing. We're looking for an inflection point, which brings us to proof point 3. The growth is demonstrably reaccelerating. What does the recent data show?
The recent figures from the third quarter of 2025 are pretty striking because they confirm a clear turning point. Third quarter revenue rose 7.2% year over year.
7.2%. Okay, how significant is that jump in context?
It's massive. You have to compare that 7.2% jump to the 3.4% growth they posted in the first half of the year, or the even more modest 2.2% growth for the entire preceding year of 2024.
Yeah.
The acceleration is undeniable.
And for established retailers, we always have to look at comparable store sales, or CSS. This tells us if the existing locations are growing, not just new stores being open. What were those CSS trends doing?
So CSS growth came in at 3.9% for Q3. If you look back, the source material described the 0.2% CSS growth for all of 2024 as anemic.
Anemic, yeah, I can see that.
So a jump from basically zero growth to 3.9% confirms that the customer base is re-engaging in spending again at their established stores.
Which brings us directly to the fourth proof point, normalizing consumer spending trends. We have to talk about the strange period this company just went through.
Yeah, the COVID years.
Right. Why did 2023 and 2024 look so weak? And why are things improving so dramatically now in Q3 2025?
Well, this connects TSC's performance directly to the famous pandemic timeline. The company was essentially whiplashed by just unprecedented demand during 2020 and 2021.
Right, we saw the famous pandemic goods bubble. People weren't traveling, they weren't dining out, so they just poured money into their homes and lifestyles.
Exactly. We saw this surge in rural migration, the home renovation boom, and a massive increase in people starting hobby farms or adopting animals. This created a colossal pull forward in demand for everything TSCO sells, from chicken feed to fencing to light equipment. They basically sold several years' worth of goods in 2 years.
So, in essence, 2023 and 2024, they weren't reflections of poor business execution, but really just the unavoidable hangover as the market digested that pull forward.
That's the perfect way to put it.
People already had the tractor and the fence and the tools.
That's the precise interpretation. The market has now digested that surge. So the current settling of spending patterns into more typical ranges is essential. It allows their underlying business strength, that necessity-driven niche, to shine through again. This normalization is what supports the path back to their longer-term earnings algorithm.
That trajectory sets the stage beautifully for the fifth and final proof point, the bold long-term outlook. Let's look ahead to what management promised at their late 2024 Investment Community Day.
Right. Management was very clear. They're confident they can return to the impressive, normalized growth levels that, characterized their pre-pandemic success. They laid out very specific targets for the end of the decade.
Okay, let's run through those numbers because they're pretty central to the whole bullish case here.
For sure. For annualized sales growth through 2030, they're targeting an average rate of 6% to 8% per year.
6 to 8.
Average annualized comparable sales growth is pegged at 3% to 5%. And critically, they're projecting average annualized earnings per share growth of 8% to 11%.
8 to 11% EPS growth. That is robust for an established retailer. And they're not just relying on organic store growth, right? The plan also includes steady share repurchases, which mechanically reduces the share count.
Yep, giving a further strategic boost to that EPS number. It's an aggressive but, I think, achievable algorithm, provided the current acceleration we saw in Q3 is sustained. It just shows management is committed to growing the pie and actively managing the shares.
So if the business is resilient, the dividend is secure, and the long-term targets are this bold, what does it all mean for the stock's price today? How did the analyst view the company's valuation?
The analysts view the current valuation of less than 26 times earnings, the PE ratio, as conservative, and that's relative to the company's expected growth trajectory.
Conservative, yes, but here's the critical challenge. This 26 times TE is a noticeable discount compared to other premium retailers.
Big time.
Costco, for example, trades at a massive 49 times earnings, and Walmart's at 37 times. Why is TSCO trading so much cheaper than those blue-chip competitors? What risk justifies that kind of discount?
That is the right question to ask. And the discount exists primarily because, while TSCO is highly successful, it's still smaller, it's far less geographically diverse, and it serves a specialized, maybe slower-growing demographic than a global giant like Walmart or Costco.
Right.
Those rivals command premium multiples based on their massive scale, their market dominance, and, their proven ability to diversify really fast.
So while the analyst agrees that 26 times earnings isn't exactly a bargain valuation in an absolute sense, they believe it's a fair price
If the company can actually deliver on those aggressive 2030 targets.
That's the conclusion. The whole analysis rests on the belief that the current operational acceleration and the underlying resilience of their rural niche make it highly probable they will hit those long-term financial targets. The market, it seems, hasn't fully priced in the end of the pandemic hangover just yet.
What a fantastic look behind the curtains of a niche leader. So, to summarize the core investment thesis for you, the listener, this claim relies on 5 main pillars. First, a resilient niche protected by a decade-long competitive moat.
Built on those unique store formats and necessity products.
Right. Second, a very strong dividend track record, 16 years of consecutive raises backed by an extremely conservative 44% payout ratio. And then third and fourth, the demonstrated reacceleration in Q3 of 2025 signals the definitive end of that temporary post-pandemic spending slump. And, connecting all those dots, the whole picture relies on the idea that this post-pandemic normalization allows TSCO's underlying business strength to really shine through and lets them meet those ambitious 2030 goals of 8 to 11% EPS growth. Their model is sound. They just needed the economic cycle to settle down.
Which leaves us with a final provocative thought for you to consider. Given those aggressive long-term targets, that 8% to 11% EPS growth, and the fact that they're only paying out 44% of their earnings today, management has a pretty crucial capital allocation decision ahead of them.
A very interesting one, yeah.
How much of that projected EPS growth will the company prioritize toward maintaining their 16-year dividend growth streak versus reinvesting heavily in new stores and evolving the unique format that gave them their competitive moat in the first place? It's a fascinating balancing act between rewarding investors today and, well, building the moat for tomorrow.